Right, good morning everybody. I hope you're all well, and thank you to everybody that's joined our first webinar of 2024. We're hoping to make this a regular occasion, probably looking at once a quarter, so keep your eyes out for fresh invites to webinars. If we can just flick to the first slide, please, guys. So just a bit of a quick agenda of what we're going to cover off today. So we're going to talk about the UK property market, obviously, which I think is what everybody's joined here today to talk about. We're going to kind of dig into some of the challenges in the market in today's market. We're going to give you some of our predictions for what they're worth, but there's a lot of experience on the call today, so I'm sure we won't be too far off. We're going to dig into some mortgages, both for offshore and expat investors, as well as UK citizens when buying property. And then we're going to talk about a specific and exciting investment opportunity we've got. Today we're going to focus on Manchester. So we've got a really good development up in Manchester there that I won't steal Sean's thunder, but yeah, Sean's going to talk us through that. So if I can just introduce who's on the call today. So obviously there's myself. So I've been in the industry for 20 years now. I have been with Centric for 12 of those, and recently obviously started working with the guys on the call here with Centric Invest. So my role is New Homes and Investments Director, and I'm based here in the UK, predominantly in Birmingham. We've got John Treacy, Expat Investment Director. Again, I'll let John introduce himself once he gets to his slides. Our colleague Sean as well, also based out in Hong Kong. Again, Expat Investment Director, and we're joined by a special guest, Neil Jensen of UK Mortgages Asia. Today, I think he's joining us from Singapore, so exciting panel. So if we could have the next slide, please, guys. I'll let all of the individuals introduce themselves as their slides come through. So I just want to tell you a little bit about Centric Invest, because it's quite a new part of our business. So Centric Invest was set up the early part of 2023 to help developers distribute their properties here in the UK, or UK properties. The UK market, particularly the investment market, slowed a little. So particularly where developers have got a number of units they need to get rid of. We've now got distribution channels through different locations across the globe, and predominantly based out of Hong Kong, where we will distribute the properties, selling them through wealth managers, IFAs, our own database. This is allowing our clients to also get early opportunities. So when we're launching a development, people that are registered with us at Centric Invest will get an early introduction to that site before it goes live across any portals across the UK. So it's a really good way of getting an early in to any investment opportunities. So the team at the moment, as I said, there's myself based here in Birmingham in the UK, and then we've got John and Sean predominantly based out of Hong Kong and around Asia. So I'm going to hand over to John, who's going to talk a little bit about the UK property market. But John, if you would like to introduce yourself, give us a quick intro, and then take it away.
Hi all, I'm John Treacy. Today I'm coming from Singapore. I'm normally based in Hong Kong, but I cover the Asia region. As you can tell from my accent, I'm originally from Birmingham, so yeah, I know the Midlands very well, and it's an area that we really focus on. But yeah, based in Hong Kong, so looking forward to speaking to you tonight. So next slide, please. Okay, so some facts in the market. So just a few numbers to kick off with. So average asking price right now in the UK market is £355,000. Prices were just adjusted downwards by sellers 1.1%, based off a year ago. The average rents are really on the climb. Over £1,200 a month now. Interest rates, and this is going to be a big topic tonight. The average 5-year interest rate is around 5.1% at the moment, but that's changing on the hour, it seems, at the moment. So that's something we're really going to dig into with Neil. And you know, last year people say it was a quiet year, but still £30 billion is still invested in buy-to-let property last year. So you know, significant. Next slide, please. I think people need to look back sometimes just to realise how good property is. I think we can all get caught in the moment and look at a headline or a very short period of time. Over 50 years, the UK property market has annualised at 6.5%. It doubles every sort of 10 to 12 years on average. So I think as long as people are looking at the long term, for expats like myself and for my clients in Asia and the Middle East, they're looking at a pension pot. So looking to put a deposit down, get a mortgage and save for the future. Now, if you do go into property and you are willing to hold for 5, 10, 15 years, you are going to do well generally. You know, it's only if you look to sort of buy today and flip in a year's time that you might be caught short. Interest rates, Neil's going to talk about that. But yeah, as long as you look at the long term, you know, you'll always do well. 6.5% annualized over 50 years. All right, thank you. Next slide. Okay, what are the drivers of the market? Let's get into that, please. All right, so there are always things which can spike the market quite quickly, be it good or bad. So interest rates, when Liz Truss came out with the under her parliament, very short parliament, her stamp duty, the interest rate went up quite quickly. Stamp duty can be a good thing when there's a loophole, when it's going to be a lower amount. If there's a rush to get things in the property market, you've seen that in years gone by. And then there's more sort of long-term fundamentals like supply and demand, which we're going to come on to, where the UK needs 300,000 new homes plus a year, and there's not enough being built. So that's an ongoing thing. Demographics, things are changing. Social, you know, COVID's changed things. People want more space sometimes. Millennials are looking to rent instead of buy. So there's all sorts of things. But I think the key drivers right now are supply and demand. There's not enough property, hence the rents are going quite crazy upwards, and interest rates have been high, but they look like they're starting to drop. So those are two key factors that I'd look at as key drivers right now. Okay. What are the challenges in the market? Okay. So look, affordability for me is the biggest factor. When people can't afford a mortgage payment or look at buying a property, go, actually I can't afford to upsize or buy that second home, that stops people in their tracks, and that's probably what's happened in the last 12 months. Less people have bought because they don't think they can afford it with the interest rates as they are. Now, as that drops off, you'll see a bigger spike in activity in the marketplace. For me, affordability is the biggest trigger for this year. Property prices, you know, have been projected to grow a few percent this year, so that will also create a pack mentality where people like to buy generally, be it the good strategy or not. When prices are on the rise, that's generally how markets work. The housing shortage is something that's not going away. Unfortunately, we've gone through something like 6 housing ministers in the last sort of 2 or 3 years. So the supply is so tight. 212,000 homes were built last year, but with a target of 300,000. Now 212 was a good year. You know, most years is more about 150,000. So that supply is continuing to be under what's needed, and that is a big challenge for the market. Unfortunately, if there's not enough property, rents get higher, landlords put the rents up, so they're big challenges for the market. But probably a good time to be a landlord, not a tenant. All right, next slide. Okay, just to highlight disparity, you know, when I first went to Hong Kong 16 years ago, it was London or nothing. People only invested in London. People didn't touch the Midlands that much or the Northwest. Now you are seeing a huge amount of buyers buying in those places. London, average price in London is £537,000, and with a much higher stamp threshold over 500k and over even higher over $1 million. The West Midlands, which is namely Birmingham, 253,000, where the Northwest, Liverpool, Manchester, Preston, 230,000. So London is more than double those two places. So we do see a big interest in the two ones, be it Birmingham and the Northwest, be it Manchester. Okay, next slide. Okay, what are predictions for this year? Okay, we took a lot of next slide, please. We took a lot of data. There's huge amounts of data coming out in the market. Different people, Rightmove, the Times, Now, the Times have said prices to go up 5% this year. I've seen some as low as 1%. We tend to take a cautious, conservative view of around 2 or 3% growth this year. I think that could be as a whole of market. Now, Savills, I read a lot of their reports. They've said could be as high as 8% in certain sectors. They've pinpointed the Northwest for growth of 8% this year. Now, over the next 5 years, the whole of the market, you've got to remember London represents a huge amount of the market, will grow by 12%. Places like the Northwest and the West Midlands, more like 20%, in our opinion. What can we expect? Rates to stabilise, interest rates to stabilise, and to probably drop. Neil will come on to that, and increased demand. When rates drop, there will be increased demand and more activity. When there's more activity, prices go up. So to put our finger in the air and to put our name on the line, I would suggest a 2 or 3% growth as a whole of market, and places like Birmingham, Manchester, probably more like a 5 or 6% growth in purchase prices. Probably a couple of percent, 2 or 3% growth in rental values. Won't be as crazy as last year. I think they do need to slow down a bit on the rental values. All right, next slide, please. So I'm going to pass over to Neil Jensen, who I've known for a good over 10 years. He's also in Singapore. All right, Neil, welcome.
Thanks, John. Can we have the next slide, please? And I'll introduce myself at the same time. Well, good morning, good evening, wherever you're watching this. I'm in Singapore. I'm normally based in Hong Kong. Now, I wanted to put this slide back on. You've seen it already. This is now my 36th year working. I know I don't look it, but I wanted to put this slide back on because one of the few benefits of actually getting old is that you see trends over a period of time. And I want you to have a look at the base rate at the year end at the bottom, and you can see this generational gap to the right of the slide, where you can see that the base rate went up to 5.25%, and we're all getting maybe guilty of getting carried away that rates are getting out of hand and the market's going to crash and what are we going to do? But if you actually look left on that graph, this is probably still in history of base rates, certainly in recent history, this is actually quite low. The market dropped for a reason. The 2009 financial crash, rates went down. It wasn't a typical period of time. What we've actually got here, though, is we've got a generational gap whereby, you know, in fairness, if you're 34 or younger, you haven't been in an environment where the base rate has been more than 1%. Therefore, I understand that this is something new to a lot of people, and therefore they haven't seen it before. Sadly, I have, and I think that's one of the reasons why, you know, talking to John and a lot of the clients and Sean, we weren't panicking about this. I think the worry was more people worried where the limit was, and I think if we can move on to the next slide, I'll talk about that in a bit more detail, please. Okay, so if we look at the bottom, there's the base rate. We all know it. There's no point in me repeating it, but literally every month the base rate was going up and up and up. Now, if you see at the bottom of the slide with the 5.25%, that line is now longer. And suddenly people feel that we've reached this cap. If you look at the slide at the top, this is average fixed rates, all loan to values. Now, the base rate is currently 5.25%. I don't buy into this, that the base rate's going to go down rapidly. I'm not even sure it's going to go down soon. I don't believe the Bank of England really want to drop rates too much, because the reason that they were higher was to stop people spending. And the danger is they do drop the rates and everybody starts spending again. You have to bear in mind that the banks are now earning 5.25% on every deposit that they have. At the lower end of the market, they weren't making anything. So they were actually having to charge a premium to borrowers in order to cover the cost of the deposits. The average deposit rate that a bank is paying at the moment is 1.14%, which means that on the average savings account, the bank is making over 4% interest on the client's money. That means that they can now start to get competitive with the borrowers. So if you're seeing mortgage rates around the 5% mark, well, the banks are still probably making money. You're going to probably see a price war with the banks because transactions have been down. And I do believe that speculation drives the market. So if we look at the left-hand side of the top graph, John was talking about Liz Truss and the mini budget. The base rate at the time when the mini budget was on was 3%, but fixed rates within a few weeks went up to 5.9%. That's a huge difference between the base rates. So you can't always say that bank lending rates are going to be the same as the base rate, because some of that is speculation. What I like about this, and what I'd like people to take away, is that people feel that the worst is over. The sun is coming out again, spring's coming, the summer's coming. I think the buyers will come out, the worst is over. And because that graph is starting to go down, there's a belief that rates themselves are going down. Whether the base rate goes down or not, yes, it would be good, but I believe that rates will drop anyway because the banks need to do that. So I'll take questions, but that covers the rate. So I'd like to pass on to Sean Bennett now, and he'll go back onto the property.
Cool, good stuff. Thanks for having me, Neil. Yeah, as Andy mentioned earlier, I'm actually based in Hong Kong, but cover the Middle East and Asia. So predominantly work with expats, helping them with kind of an end-to-end service, helping them find properties, mortgages, lettings and management, things like that, but also work with some UK-based clients too. So cool, I'm just going to run through a little bit, not going to go into too much detail. We can run through a lot more detail with you guys on a kind of one-to-one basis, but just to give you a bit of a flavour of our best selling development at the moment, and one that's been really popular and one that I really like. If you go to the next slide. So first off, why Manchester? So Manchester's obviously the face of the Northern Powerhouse. We hear a lot about the Northern Powerhouse and the government kind of infrastructure investments that go in there, the likes of the BBC, the ITV head office, lots of media and tech head offices up there, and lots of FTSE 100 companies. I think it's 86 is the updated number of the FTSE 100 companies have offices in Manchester. So looking back at the last 20 years, it's had the highest GDP growth, being how much that the city produces. It's actually got the second largest economy in the UK after London, of course. It's had, over the last 20 years, had the highest rental growth, and it's had the highest property price growth as well. So again, looking back is always a nice kind of a way to sometimes see what's happening in the future. Whenever you look at any kind of expertise or property specialist forecasts are what they are, but Manchester repeatedly comes at the top of those too. The likes of JLL, the likes of Savills, the likes of Knight Frank, all expect Manchester to have some of the highest growth and also some of the highest rental growth too. It's had the best place to live in the UK for the 5th year in a row. It's had a 20% rental growth over the last 12 months. The one thing which also isn't on here, which I really like, is the fact that it has the highest student retention rate in the UK. So Manchester and Birmingham both have around 50% of student retention rate. So people that go to university staying after university. So whilst I don't necessarily, I'm not suggesting targeting students as tenants, but those young professionals are the people we're often targeting. And what that says to me is that high student retention rate, there must be job opportunities and people must like living there as well, right? So it's definitely a good thing. If you go to the next slide, please. Cool. So the development I'm going to talk about briefly is called Trafford Gardens. Next slide as well. So you guys that know Manchester, or if you don't, it's kind of split into two cities, I suppose. If you go to the next slide, there we go, got it. Split into two cities. So you've almost got the kind of prime city centre, Deansgate, Spinningfields, all those kind of areas, and then you have that Salford Quays kind of Trafford area. The Trafford, of course, is home to some of the most famous sporting sites in the world. You've got number 1 Old Trafford. You've also got Trafford Cricket Ground. The development itself is a 3 to 4 minute walk from Trafford Bar Metro line, okay, which is a new metro system. I suppose it goes around Manchester. It takes you from there to Deansgate, which is where a lot of the kind of corporate offices are, in 7 minutes, and then also takes you to that Media City, BBC, ITV head offices in 8 minutes. Although it's closer, it takes a little bit longer than the tram with the route. So connectivity is great. got really easy access out to the M6, out to Manchester Airport. But it's also got a lot of those kind of young amenities that young professionals like. It's got a gym, it's got an M&S, it's got a coffee shop in White City Retail Park, which is just next door. Now, that's the kind of area, I suppose. The thing that I really like about this, and I think the reason why it's been so popular with our buyers, is that so the reservation process, effectively you pay a £2,000 reservation fee, which is a part of the purchase price, but it's to secure your property. In a month's time, you exchange contracts, and basically you only pay 10% of that property price on exchange. Okay, so you only need an initial 10% to get into this property. So, for example, you get a 2-bed for £220,000. You need £22,000 to get that property. That first 10% has got deposit protections in place. Okay, if anything were to go wrong, which with us it never has, but it's there just in case, which is always nice. Has a 10% deposit protection in place. You pay another 10% 6 months later, and then you pay the remaining 80% on completion, which is Q1 next year. It's almost like a little bit of a payment plan: 10% now, 10% 6 months time, and then another 10% estimated for your fees and your stamp duty in another kind of 6 months time. So it's a nice payment plan. And also, Neil's already spoken about the mortgage rates, and the expectation is that they will be lower in a year's time. So you can access the market, you can have growth on that property during the build period. But the interest rates are expected to be lower, so you can benefit from that side too. Cool. Can you go next slide, please? So I've spoken to the location a little bit, so I won't go into that again. But as we know, Manchester is, as I said, the king of the north, as they like to call themselves. So this is an example apartment. Okay, so this is a 1-bed apartment. Its price is £220,000. So again, you need £22,000 now, £22,000 in 6 months, another roughly £22,000 in another 6 months after that. Again, that's an estimate. We can do comprehensive cash flows with you guys as well to give you an example of what to expect. Now, going off a rent of £1,100 a month, which is more than achievable based on the rents that are already happening. We did a development previously just next door called number 1 Old Trafford, where the rents are already achieving that. So again, in another 12, 14 months time, the rents are only going to be higher than that. That's going to give you a 6% gross yield and a 5.5% net yield. 5.5% net yield. Now, the average yield in the UK is on 4.5%. Okay, so you're above that, and on top of that, you're getting some of the highest capital appreciation in the UK also. Next slide. I believe that's it. So I'll pass you back to Andy if you guys have got some questions. I'm sure you have. I think we can all just pop on and answer them as we go.
Yeah, thanks for that, Sean. It was really good. I think Rightmove also had some stats out this week that Manchester appeared in the top 10. Is actually number 2 for most searched location by tenants. There's clearly huge demand from the tenant population, and also it appeared in the top 10 for home buyer searches as well. So some really strong stats there from Rightmove. Okay, let me just check on the questions. So one we've got here. I think it's probably one for you, John, is your top picks for investment areas or locations in the UK.
Obviously, Manchester is a pick. Obviously, Sean's just gone into that in detail. For me, Birmingham has always been a really strong play. The HS2 story, long term. The banks moving there long term. I've been involved in the Birmingham market heavily since 2015, and the city centre is getting to sort of circa 230 upwards for a 1-bed. So we see real value in regional, commuter Birmingham, i.e. 15-20 minutes outside the city centre, but with a really strong regeneration story. So we've got a project ourselves, which we'll launch in February, which is commuter Birmingham, with a really big developer, FTSE 250 company, and purchase price is circa sort of 180. 185 instead of 230. So that's really our hotspot pick to watch. If people are interested in that one, just drop us a message, because that one is going to be something quite special for us this year. So for me, Manchester, really love that site, and that's going really well. But then commuter Birmingham as my number pick for the year. All right.
Brilliant. Thanks, John. Appreciate that. Another one, I think probably for you, Neil, here. What type of deposit or amount of deposit should I look to put down? And I suppose there might be 2 answers here for a UK investor versus an international investor.
I mean, I would always say to anybody, you should probably have about 25% that you're putting down, even if you're a UK investor. The banks are still stress testing on the mortgages. So if your say your interest rate is 6.39%, they're putting another quarter on top of that. So they actually take a rate of 7.99. Bank of England said they don't need to do this anymore, but it still seems to be doing it. What that then means is you need to be buying a property that's got a fairly high rental yield, because your monthly rental needs to be the same as your monthly mortgage payment at that stress tested rate. Now, I'm pleased to say, and I'm not biased in any way, that pretty much every deal that we're doing through Centric at the moment is coming out at between 71 and 75% for clients. And John's nodding because we speak all the time about it. But look, you know, there's always other factors. I mean, there are lenders in the UK, you might be able to get 80%. Your first property, actually, there's less lenders than your second property once you become an experienced investor. It's interesting, a lot of people say to me, oh, will it go against me because I've already got a property, I've already got a mortgage. Actually, there's more lenders for the second one than there is for the first, but there's plenty for the first, so you shouldn't be worried about it. But I would say have at least 25% if you can. And if you haven't, one of the great things is, this, as Sean's talked about Trafford Gardens, you can save it up. You need some for the deposit now, but if you think mortgage rates are going to come down a little bit more, then you've got the great benefit of reserving something at today's prices and starting your mortgage in a year and a half's time. So best of both worlds.
Brilliant. Thanks, Neil. One I get asked a lot as well, just to throw it in there, is about their own personal income when they're buying an investment property. Do they need personal income to kind of guarantee any void periods, that kind of stuff? Or could you get a mortgage if you didn't have any income?
I can get somebody a mortgage if they've got no income. It's better if they do have income. But yeah, I mean, we've done mortgages for people without income as well. It really depends on your background. If you've got assets but you don't have income, then that can work. If you have other properties but you don't have income, that can work. If you don't have assets and you don't have income, you're probably not buying the property, so that isn't ever a problem either.
Okay, brilliant. All right, one here. For fairness, Sean, I think you should take this, but it probably is similar to what John answered. So a bit about your predictions for the year and what is your best pick market-wise?
Sure. Yeah, I mean, like John said, forecasts and projections are what they are. You have to take them with a little bit of pinch of salt. I mean, even when COVID started, people were saying prices were going to drop, and they're now about 20% higher than that. A lot of people said last year prices were going to drop 10%. And even when you're looking at that now, I mean, I was looking earlier, Halifax said the prices dropped 1.7%, I think, last year, and then Nationwide said they went up 1.8%. So it's not always easy to kind of cut through the information. I think we can all agree that property is a long-term investment. Just a few days ago, we saw that Knight Frank came out and said they're expecting a 3% growth this year, and over the next 5 years, about 20% growth. So I think John touched on it earlier. I mean, if you kind of take the average, what a lot of different people are saying, some are saying a bit of a drop, some are saying at 5%. I think probably it's going to go up a couple of percent this year, and especially when you're looking at those key areas. I know we're hammering them home, but those kind of regional cities like your Birmingham, like in Manchester, like, you know, some other perhaps regional cities that have some government infrastructure investment going into them, and that means that people moving there, companies moving there, they have young professionals. You know, you're going to outperform the rest of the UK as well, right? I think, again, just to hammer down, it's all about those kind of long-term investment goals.
Yeah. Okay, brilliant. I don't think there's any more questions that's come in. Let me just check. No? Okay. Well, thanks for your time, guys, from across the globe. We've got Hong Kong and Singapore and sunny Birmingham. So, yeah, if anybody has any questions for Sean, myself, or John, please get in touch. You can get in touch on our website, centric.co.uk. We'll put a few links out on this. And obviously, if anybody would like to speak to Neil in particular about finance and mortgages, then again, get in touch with us, and we're more than happy to make a direct introduction to Neil. But yeah, I suppose that wraps it for today. So thanks everyone, and hopefully we'll see you again next quarter.
Thank you,
Cheers, guys.